Hi everybody, and welcome to our last video, number 8 in chapter 9. Here we're going to describe the accounting for contributions. Now, in this case, companies should use the fair value of the asset to establish its value on the books and recognize contributions received as revenues in the period in which they are received. So contributions are either unconditional or conditional, and that's important, especially for nonprofits. The criteria for evaluating whether contributions are unconditional and thus recognized immediately in income, or conditional, for which income recognition is deferred, depends on the terms of the gift or the grant agreement. The focus is whether a gift or a grant agreement has the following terms. 1. It specifies a barrier or hurdle that the recipient must overcome to be entitled to the resources. A barrier is the inclusion of a measurable performance requirement, such as a degree of completion or specific output or outcome. And then number 2, releases the donor from its obligation to transfer resources, or, if the assets are advanced, a right to demand their return if the barrier or hurdle is not achieved by the recipient. Okay, let's take a look at that. State insurance company agrees to contribute $1 million to DV to provide specific career training to disabled veterans. The contribution requires DV to provide training to at least 8,000 disabled veterans during the next fiscal year, with a specified minimum targets that must be met each quarter. State insurance requires a right of release stipulation from the obligation in that it will only give DV $250,000 each quarter if DV demonstrates that those services have been provided to at least 2,000 disabled veterans, that's 1/4 of the 8,000 total up there, during the quarter. State insurance makes the payments at the end of each quarter. The question is, does the arrangement between state insurance and DV a conditional contribution? And I think fairly obviously that it is conditional. The agreement contains a right of release from the obligation because state insurance will only transfer assets if DV provides the training to 8,000 disabled veterans during the year, with a minimum requirement of 2,000 disabled veterans per quarter. State insurance requires DV to achieve a specific level of service that would be considered a measurable performance-related barrier in the form of milestones for specifying the 2,000 disabled veterans per quarter. Now, if there is an unconditional contribution, we do that a little differently. Giller Science receives a grant of land with a fair value of $1 million, but it costs them $600,000. From Progress Pharma Company to build additional research facilities to advance Giller Science's study on stem cell adaptations. Progress Pharma does not specify any restrictions to the grant. The question is the arrangement between Giller Service and Progress Pharma unconditional? If so, prepare the journal entry. This is unconditional because there are no restrictions associated with the contribution. Giller Science records the land received at its fair value and contribution revenue as follows. Here's the land for $1 million. We debit that. Contribution revenue, $1 million. Okay. Now, exchange transactions If both the recipient and the resource provider agree on the amount of assets transferred in exchange for goods and services that are of the same value, the transaction is accounted for as an exchange rather than a contribution. The accounting for this transaction would follow the normal rules for exchanges using the revenue recognition guidelines discussed in chapters 3 and will be discussed in chapters 17. Let's take a look at an illustration. Outstanding University is a large research university with cancer research department. Outstanding receives $800,000 from Precision Company to finance the cost of a clinical trial of an experimental cancer drug that Precision developed. Precision specifies the protocol of the testing, including the number of participants to be tested, the dosages to be administered, and the frequency of follow-up examinations. Precision requires a detailed report of the test outcomes within 3 months of the test's conclusions. The rights to the results of the study belong to the outstanding university. Should this arrangement be considered an exchange? Well, Outstanding University and Precision Company should consider this grant to be an exchange, because the results of the clinical trial have commercial value for Precision. Precision is receiving commensurate value as the resource provider. Therefore, the receipt of the resources is not a contribution received by Outstanding University, nor is the disbursement of the resources a contribution made by Precision. The accounting for this transaction would follow the normal rules for exchanges using revenue recognition guidelines discussed in chapters 3 and 17. Okay, that ends chapter 9. And when we return, we will start with chapter 10. Until that time, bye for now.